In today's discussion, we'll delve into the preparations made by the DTCC, Depository Trust and Clearing Corporation, to handle substantial losses associated with mass events. They've recently crafted a comprehensive plan for either recovery or winding down the entire DTCC. Additionally, we'll explore recent developments concerning Mullen, who received a delisting notice and subsequently filed an appeal, alleging that the decline in their share price resulted from illegal market manipulation. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. The DTCC plays a pivotal role in the functioning of the global financial system. It is responsible for clearing and settling trades in the equity, fixed income, and derivatives markets. Given its critical role, any significant financial losses incurred by the DTCC could have far-reaching implications. To mitigate such risks, the DTCC has taken proactive measures by developing a comprehensive recovery and wind-down plan. This plan is rooted in regulatory requirements, specifically Rule 17 AD 22 E3U. Under this rule, registered clearing agencies like the DTCC are mandated to establish and maintain plans that outline the orderly recovery or wind-down of the agency in the face of various adverse scenarios. These scenarios encompass credit losses, liquidity shortfalls, losses stemming from general business risks, or any other losses that could jeopardize the DTCC's ability to provide essential services. In essence, this plan acts as a safety net, ensuring that in the event of significant financial turmoil, the DTCC can take swift and organized actions to protect the integrity and stability of the financial system. It's a proactive approach to addressing potential challenges that could arise in the complex world of modern finance. Now let's shift our focus to Mullen, an automotive company that recently found itself in a precarious situation. Mullen received a delisting notice from the Nasdaq due to its failure to maintain a minimum share price of $1. In response, Mullen took the step of requesting a hearing, which effectively put the delisting on hold pending a final decision. What makes this case particularly intriguing is Mullen's assertion that the decline in its share price was the result of illegal market manipulation. This accusation has far-reaching implications and underscores the complex dynamics at play in the financial markets. Mullen's decision to file a lawsuit against several brokers and trading platforms, including prominent names like TD Ameritrade and Charles Schwab, rather than targeting market makers directly, such as Citadel, merits a closer look. The rationale behind this strategy is that brokers and trading platforms are integral to the process of facilitating the sale of synthetic shares. Market makers like Citadel are involved in creating synthetic shares through short-selling practices that do not require actual share ownership. However, to conduct these synthetic short sales, hedge funds need someone to sell these shares to, and this is where brokers and trading platforms come into play. They serve as intermediaries, enabling the trading of these synthetic shares with retail investors. In simpler terms, while market makers and hedge funds collaborate to generate synthetic short sale shares, it's the involvement of brokers and trading platforms that allows these shares to be sold to retail investors. Without brokers or trading platforms facilitating these transactions, the creation of synthetic shares would be futile because there would be no counterparties to buy them. Consequently, if these brokers and trading platforms are held accountable and forced to cease their illicit activities, companies like Mullen and AMC would experience less downward pressure on their share prices. Essentially, if there are no trades occurring due to the absence of counterparties, share prices would no longer decline. This lawsuit against brokers and trading platforms has temporarily halted Mullen's delisting process, as a final decision may hinge on the outcome of the lawsuit. If it is determined that Mullen's share price fell below $1 per share unfairly due to manipulation, rather than natural market forces, then the case for delisting becomes less clear-cut. The progress of this lawsuit will be closely monitored, as it could have broader implications for how market manipulation is addressed in the financial industry. If brokers and trading platforms are found guilty of their alleged misconduct, it could set a precedent for increased regulatory oversight and accountability in the markets. In our discussion, we've also touched upon the concept of reverse splits, specifically in the context of AMC. It's important to distinguish between a reverse split and dilution, as these are distinct processes with different implications for a company and its shareholders. Dilution involves the creation of new shares, which can reduce the proportionate ownership of existing shareholders. This process can be contentious, particularly in the context of a heavily shorted stock, as it introduces more shares into the market, potentially diluting the value of existing shares. In contrast, a reverse split does not create new shares. Instead, it consolidates existing shares by reducing their quantity while increasing their individual value. This often results in a higher share price. The significance of a reverse split lies in its ability to make shares scarcer, making it more challenging for market makers to locate shares for short selling purposes. In the case of AMC, a reverse split proved to be strategically valuable. Without this action, AMC's share price could have fallen below $1 per share, similar to Mullen's situation. In such a scenario, short sellers could have exploited this by keeping AMC's share price below $1 for an extended period, which could have benefited them. However, the reverse split prevented this outcome by ensuring that AMC's share price remained above $1, forcing short sellers to work harder to push it down. As a result, AMC avoided delisting, which could have had dire consequences for the company and its shareholders. The reverse split, in this context, served as a protective measure to maintain the stock's eligibility for trading on major exchanges. Shifting gears once more, let's examine the intriguing case of GameStop and Ryan Cohen. Zero Hedge reported a 5% drop in GameStop stock following news that the SEC was investigating Ryan Cohen for his trades in Bed Bath & Beyond. This development raised eyebrows due to suspicious trading activity preceding the announcement. Notably, it was observed that there was a significant increase in put options trading on GameStop the day before the news of the SEC investigation broke. This surge in put options trading implied that some individuals had inside information regarding the impending investigation and acted on it. The question that arises is whether this constitutes insider trading. Insider trading is a violation of securities laws and involves trading based on material, non-public information. In this case, the unusual spike in put options trading just before negative news emerged certainly raises suspicions. This situation prompts further examination of who might be the subject of an SEC investigation. While the initial focus was on Ryan Cohen, it's worth considering whether the SEC should widen its probe to encompass those who engaged in potentially illicit trading based on insider information. In conclusion, these developments underscore the intricate and sometimes contentious nature of financial markets and regulatory oversight. The DTCC's proactive approach to preparing for potential mass losses is a testament to the vigilance required to safeguard the stability of the financial system. Mullen's legal actions and the ongoing lawsuit against brokers and trading platforms highlight the complexities of market manipulation and the potential consequences for companies and investors. Finally, the role of reverse splits in preserving a stock's eligibility for trading on major exchanges and the suspicions surrounding trading activity in the GameStop case demonstrate the ongoing challenges and scrutiny faced by the financial industry. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.